Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I also focus on regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. Let's talk about a big question I get every week. Are Singapore bank dividends still worth it in 2025 after the rally? Many think yields are gone. Prices are high. Fixed deposits look safe. But here's the twist. The three big banks still pay around 4.5% to 6% in dividends this year, and some are adding specials or capital returns on top. I've distilled the entire story into 7 crucial points that will change how you think about bank stocks. These points can shape your passive income plan, your CPF/SRS strategy, and your total return over the next few years. Here's what we're covering today. 1. The real 2025 dividend ranges you can expect. 2. Why these payouts are sustainable despite rate cuts. 3. How payout cadence affects your cash flow. 4. The key risks that could change the math. 5. The best match between each bank and common Singapore investor goals. 6. Clear buy, sell, hold strategies that fit our market. 7. A simple action plan you can use this week. Now let's dive in. Point 1. The real dividend ranges in 2025. The core numbers are simple and useful. Ordinary yields sit around 4.5% to 6.0% at recent prices. When you include declared specials or capital returns, the total can rise to about 5.7% to 6.4%. DBS pays quarterly and has a recurring capital return payout this year. OCBC has one of the highest base yields and a 2-year capital return program. UOB offers a solid ordinary payout and a 50-cent special in 2 tranches for 2025. Think about this, like choosing between a steady monthly paycheck and a bonus. DBS is like monthly payday. OCBC and UOB hand out bigger checks less often, sometimes with a bonus on top. Point 2. Why payouts look sustainable. Dividends come from 3 engines: interest income, fee income, and surplus capital. Net interest margins fell in the first half of 2025 as rates eased. But the banks grew fee income from wealth, cards, and treasury customer sales while keeping costs tight. Capital ratios remain strong, with CET1 above regulatory needs. Payout ratios sit in a conservative 50-65% band. This is like a 3-legged stool. If one leg, margins, gets shorter, the other 2, fees and capital, keep the stool steady. Could dividends fall? In a deep downturn, specials would pause first. Ordinary payouts are better anchored. Point 3. Cadence matters for cash flow. Cash flow timing is not a small detail. It changes how you live with your portfolio. DBS pays quarterly, 4 smaller checks a year, plus a declared capital return payout in the first half. OCBC and UOB pay semi-annually, 2 bigger checks a year. If you rely on portfolio income to cover monthly bills or top up your family budget, steady cadence helps. Picture a retiree using dividends to cover utilities or a child's tuition. Quarterly checks smooth the ride. Semi-annual checks suit those who like bigger lump sums to reinvest, clear insurance premiums, or fund a holiday. For even more detailed charts, deeper dives into the data, and a full written breakdown of today's topic, make sure to check out our Substack. The link is right there in the description. Point 4. The key risks that could shift yields. Let's be frank about the big 3 risks. First, faster rate cuts. These squeeze margins more than expected. Banks can respond with deposit remixing and fee growth, but it still hurts. Second, credit costs. A weak regional economy would lift defaults. Ordinary payouts can hold, but boards would likely pause specials first. Third, regional sensitivity. UOB's ASEAN exposure brings long-term growth and more macro swings. DBS and OCBC have broader offsets in wealth and insurance. Ask yourself, if markets wobble and dividends hold, will you add on dips? Your answer shapes your outcomes more than any forecast. Point 5. Match each bank to your goal. This is where many investors win or lose. Match the bank to the job. Want smooth monthly-like cash flow? DBS's quarterly Cadence fits. Want the highest base ordinary yield and a capital return program? OCBC stands out. Want balanced yield with special upside? UOB fits well, especially when it trades at a discount to peers. For SRS investors, tax-exempt dividends make these yields even more attractive. For CPF-linked decisions, treat banks as an equity income sleeve. It can sit alongside safer assets, but keep sizes prudent because equity can swing. Now that we've matched goals, let's pivot to practical buy strategies. Point 6, clear buy, hold strategies. Here's the playbook. DBS, buy on dips, hold at fair value. Great for frequent cash flow and disciplined capital returns. OCBC, buy for income, hold for core yield. It is often the base yield leader and has a capital return program. UOB, buy selectively, hold for balanced yield. Specials help, but treat them as a bonus, not base case. Use staged entries to avoid poor timing. Reinvest on pullbacks to lift yield on cost. Keep single bank exposure and total sector weight capped to manage downside scenarios. Point 7. A simple action plan for this week. Pick your goal. Cadence, highest base yield, or balanced total yield. Size your positions. Many investors sit in a 5 to 12% bank allocation within equities. Stage your buys in 2 or 3 tranches. Reinvest dividends when prices are weak to boost long-term income. Review quarterly. Watch capital ratios, credit costs, fee growth, and any changes to dividend or capital return guidance. Ask yourself each quarter, has anything changed that breaks my original thesis? If not, stick to the plan. Let's make this real with 2 examples. Example 1. An SRS-focused investor wants smooth income. A core stake in DBS provides quarterly checks. Add OCBC for a higher base yield. Reinvest both during dips. Example 2. A younger investor wants total return and can ride volatility. Start with DBS for quality and cadence. Add UOB when it trades at a discount to peers. Keep a cash buffer to add on down days. Now that we've covered the 7 points, here's a quick check-in. Are you relying on specials to hit a yield target? If yes, dial back your expectations and treat specials as icing. Are you over-allocated to one bank because it ran up? Trim back and spread the risk. Are you sitting entirely in fixed deposits at 2-3%? Consider shifting a slice into bank dividends for higher cash flow, but keep your emergency fund intact. Iggy's personal take. Here's my view after tracking these banks year after year. The yield story is not dead. It has evolved. Ordinary yields remain attractive. Specials and capital returns are tools, not promises. For Singapore investors, bank dividends still form the backbone of a high-quality income portfolio. My advice, stop chasing the highest headline yield. Focus on fit. If you value steady cash flow, DBS is your anchor. If you want the strongest base ordinary yield, OCBC does the heavy lifting. If you want a balanced profile with bonus potential, UOB is your swing player. For CPF-linked plans, keep equity income as a measured slice, not the whole pie. For SRS, the tax advantage on dividends makes these yields stand out. I continue to buy on dips, reinvest during pullbacks, and keep my sector exposure controlled. This approach has kept my income stable and my sleep peaceful. Let's wrap up with a fast summary. 1. Ordinary yields around 4.5% to 6.0% still hold up in 2025. 2. Specials and capital returns can lift the total to about 5.7% to 6.4%, but they are discretionary. 3. Pick the bank that fits your goal. Cadence, base yield, or balance. 4. Use staged entries, reinvest on dips, and cap exposure. Do this, and your dividend engine can drive real progress toward financial independence in Singapore. So, we've broken down Singapore bank dividends in 2025, and I've given you my personal take on how it applies to your journey here in Singapore. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $3 a month, about the price of a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today.